All right. Good afternoon, everybody. Happy lunchtime. Welcome and thank you for joining us. My name is Abby Sachs. I'm the Assistant Director for Corporate Partnerships here at Grand Valley State University, and I'm excited to be joining my colleagues in Alumni Relations, as well as our friends at Consumers Credit Union for today's webinar. A few housekeeping notes. If you'd like to ask a question at any point, we'll be kind of fielding questions as they pop up. Please use the Q&A function on the bottom of the screen. That'll be the best way to get your questions to us. We'll be monitoring those throughout. And then in the chat, we'll also be dropping some helpful links throughout as we have them. And now, without further ado, I'm pleased to introduce Matt and Sarah from Consumers, and I will let you both take it away.
Thank you, Abby, and welcome, friends in Lakerland. I am also a Laker, graduated a long time ago, about 25 years ago in 2001, and I have been a mortgage loan officer and in sales management ever since. So I've got about 25 years of experience. Here, I currently am with Consumers Credit Union and work with about 8 other loan officers here in the Grand Rapids market, as well as on the Lake Shore. Today, I also have Sarah Lewis with me, and I'll let her introduce herself as well.
Well, good afternoon. Thanks for having me. As you guys have heard, my name is Sarah Lewis. Getting a little background information here. All right, let's try that again. That again.
It is not.
Sorry, we're trying to get him muted a second.
Okay.
Let's see if that works. There we go. Well, again, thank you for having me. My name is Sarah Lewis. I am with Century 21 affiliated. I am also a Laker graduate, roughly about 20 years ago. I'll date myself. But I have been in the real estate industry for about 17 years, 7 years in the state of New Jersey, and the last 10 years here in the state of Michigan. So thank you for having me today.
Thank you, Sarah. And at this time, we are going to dive into home ownership and some of the processes and experiences that you can look forward to as you consider taking this big step in your future, if you haven't done so at this point.
Okay, so we're going to go ahead and go over some of our workshop goals for today. So we want to cover some important information to help you prepare for home ownership. It's an exciting thing to be a homeowner, and we want to go ahead and go over things such as how lenders might evaluate your loan application, steps to take and prepare for obtaining loan and costs that you're going to encounter on your journey towards home ownership. The costs and responsibilities associated with home ownership, that's something we're going to discuss today, along with the loan, the repayment process, what that looks like, and how to find out if you're financially ready to go ahead and purchase a home. So hopefully by the time we complete this course, you'll have a better understanding of how to work towards becoming a homeowner.
One of the important things to consider as you think about moving into home ownership are some of the pros and cons of doing so. And though it's great to own a home, it's also important to understand what's involved and what the benefits of home ownership are, and are there any negatives that are important to consider. Let's review some of the pros and cons of owning a home. One of the most important pros is your home is considered an asset, and an asset is something that typically will go up over time. The value will increase. There have been points in time in our history that has not been the case, but generally over time, your home as an asset continues to rise. Con is, as I mentioned, it is possible that the value may go down. There are certain things that can take place within a market, an economy, that could have a negative impact on overall value. But historically, we've seen anywhere from a 6 to 7% increase in appreciation over year in your home's value. Another pro, you need to make payments towards a home. A portion of each payment does go towards the principal balance that you owe. So as you get closer to owning that home outright, that value of your asset continues to increase. The con of making that payment is sometimes there's also a down payment involved, and there may be other home ownership costs to consider along with making those regular monthly payments. Another consideration of owning a home is you may need to pay taxes. The pro of those taxes, that some of those taxes may be deductible, so it can help in terms of offsetting income. As much as $10,000 a year in property taxes and other taxes are tax deductible in many cases. It's something that you would also want to consider talking to your CPA or financial advisor about. The con is, of course, property taxes are expensive and they do increase every year. So it's just an expense that you would have to make sure that you budget for. An additional thing to consider is you can it's your home. You're able to remodel it. You can renovate, you can decorate as you wish. This is something that is very important to most people, that they don't have to ask permission. They don't have to wait for somebody else to make those improvements or get approval. You can simply do what you would like. The con to that is everything you do, if it costs money, is something that you're going to be responsible for. So just something including repair and maintenance, anything from mowing the yard, to painting, are all things that may have a cost associated with it. Some of the other things that I think are important to talk about and understand are common terms that you will hear throughout the home buying and mortgage loan process. Probably one of the most important considerations is going to be income. And your income is money that you earn from wages. It can come from wages. There's other streams of income also that we would review and consider to help you qualify to purchase your home. It can be Social Security. It can be investment income. If you're self-employed, there are many different ways that income can be looked at. Another one is your income history. So one important aspect of mortgage or financing is going to be reviewing that income history to make sure it's consistent and stable. We're going to look at your previous income and your current income just to make sure that it's something that we feel is going to be consistent over time or increasing. Another one is going to be your debt to income ratio. That ratio is a function of looking at how much debt you have. Some of you may have student loans, car payments, personal loans, credit card debt. Those things are all going to be looked at and considered and compared to how much money or income that you are generating on a monthly basis. So that debt to income ratio is an important number on the financing side when you're looking at taking out a loan that we're going to look at very closely to make sure that your income will support the amount of debt that you currently have. Next is going to be your credit score. This is also very important just in terms of your repayment history, your loan payment history. In my world, mortgage and financing, past credit payment history is the single biggest predictor of future payment history. So that credit score is going to give us a very good idea of what we can expect you to do in the future in terms of making those payments. The higher your credit score, the better history, the better repayment history you typically have had. Last common term is going to be that down payment. Down payment can come from many different avenues. The primary one that we see is savings. So checking savings. Down payment is just a lump of money that is put down at the initial purchase of the home. It will reduce the loan amount and can offset the risk for the financial institution in loaning that money to you. That money can also come from a gift, a family member. Sometimes if you have a family member who you're buying property from, it can also be a gift of equity, can be considered part of that down payment. So many times that down payment piece is something that is a barrier to purchase. And a lot of people are afraid or don't take that initial step because they're worried that they're going to need a substantial down payment. And I have great news for anybody in that situation. There are many programs out there, and Sarah will touch on this a little later, that would allow for zero down payment or very low down payments. So we're very fortunate along those lines. Next is I'm going to dive a little deeper into credit. And credit is going to be probably the single most important piece of financing and purchasing a new home. The first piece, the consideration is the capacity. Are you able to pay your bills? Now a lot of that is going to be based on your income. And if you have enough income to continue making those payments on time. The capital piece is how much money do you have set aside, and is that money available to make those payments if needed? So that is a piece that's also factored into your credit, and it also helps to show payments being made over time consistently, because a lot of times those reserves might be needed to make a payment if income changes or there's other changes in your income stream. Next is collateral. The collateral is going to be anything that you can secure a loan to. Most commonly, we see this as a home, a property, or a vehicle. But it can be anything from motorcycles, other personal property, but those are generally the two most important ones that you'll see from a credit standpoint, installment loans being put on. The next one's going to be character. And character just really has more to do with your persistence and dedication to making those payments. So, many people don't understand and realize that anything more than 30 days past that due date is considered late. So you want to make sure that you're always continuing to make those payments. If you need to, move certain pieces of your financial picture around to make sure that those payments are not considered late, that is, part of your character and your focus on how important your credit is and managing that credit. The other one is conditions, the purpose of the loan, and any other factors that could impact the loan itself or your ability to repay. And I think those are going to be the most important things, as you work through your credit and make sure you maintain a high credit score. That's something from a risk standpoint when we're considering loan terms and giving that loan to somebody. The next thing that we are going to cover is really setting up yourself financially and considering what's best for you. Renting, many of you may rent currently, or taking that big next step and purchasing your home and owning that going forward. And some of the information that I've provided may look clear that renting is going to be a really nice option. It's going to save you a lot of money. It's going to allow you to have extra money to spend every month in terms of cash flow. But as you dive a little bit deeper into these numbers, you'll understand in the long run, in the long term, that owning your own home has very significant benefits. In this example, I just took an average rent payment for a 1-bedroom, 1-bath, just a very small unit in Kent County at $1,500 a month. I also then considered just a typical credit card payment and car payment. Of course, we've got to consider those student loans as well. Hopefully, those are minimal. So that total on that comes to about $2,100 a month. And considering owning a home in Kent County at a $250,000 price point with minimal of 3% down on a 30-year fixed mortgage, you're going to be looking at a principal and interest payment that also includes your property taxes and homeowners insurance will be in the ballpark of $2,000. Also then factoring in credit cards, car loans, and that student loan payment, you're looking at a total outflow of about $2,600 a month. So it seems in this case that, renting could potentially be more beneficial. Now, also more importantly, then you consider the wants and the needs in these two different sets of expenses. And a lot of times what we do recognize is priorities once people own a home, and we see significant changes in the things that they do with, once they own that home. So they're spending more time at home. They're not, and you can adjust those budget numbers that affect credit card payments, student loan payments, and you can make adjustments to make owning that home even more beneficial in the long term. And then, as I mentioned, the debt to income ratio is going to be something that each individual is going to have to consider very closely. And from a financing standpoint, we look at that debt to income ratio as a function of total monthly obligations in terms of credit obligations to your qualifying income. And the qualifying income also doesn't necessarily mean all of the income that you have coming in every month. So that's where a lot of times, most often you're going to hear your housing payment shouldn't be more than 30% of your income. We also recognize that we may have part-time Uber drivers, we may have part-time income that we're not necessarily able to consider for qualifying. And those income streams, because maybe it's not consistent, maybe it hasn't been earned over a long enough period of time, so we can't factor those into that debt to income ratio. So that then is something that you would have to consider. You make more money than we can factor in. So maybe you're more comfortable going with a higher debt to income ratio. Maybe you're comfortable with a housing payment closer to 35 or 40% because you've got additional streams of income that aren't being considered. And then also some people know, hey, I'm going to buy a home. We're going to be cooking at home. We're going to have our new kitchen. We're not going to be going out to dinner nearly as much. We're not going to be having Uber Eats deliver regularly, saving money and reducing those expenses. So there's a lot of things that you have to consider in terms of your own budget and your own comfort level versus just what a financial institution tells you you can afford. So those are really important considerations as we look at that debt ratio. But the debt ratio and how we calculate that is we're going to add your total qualifying income. So in this case, we're using Rory's gross monthly income. So this is the income that we're going to use before any taxes, before 401k, before insurance, anything comes out. We're going to use the top line number on that paycheck. So in this case, we're going to use his base salary of $72,000. We divide that by 12 and we come up with $6,000 a month in income. We have a credit report in front of us. His credit report shows about $600 worth of other expenses between credit cards, student loans, and that car payment, as we saw in the previous slide. When we consider the new, there we go. Sorry about that. When we consider that new mortgage of about $2,000 a month, we're looking at that total debt ratio calculation in the 43% range. Most maximum debt ratios allowable for financing is going to be about 45. We like to see it in the closer to the 40 to 41 range. But also there are programs that allow up to 50%. And again, that's where you're going to have to really consider your comfort level and understanding your own personal budget, how many streaming services you're signed up for, how much fuel you're going to spend, all of those things that we don't necessarily see and consider in these debt ratio calculations. Next is credit score. Credit score is probably one of the biggest challenges that we have on the financing side historically, because there are so many things that impact your credit score, and it can be very challenging to know exactly what is causing a credit score to be high, to be low, to move over time. And so we've got a breakdown of some of those things just to be aware of as you're working to manage that credit score going into the consideration of owning your own home. Most importantly, payment history. Have you made your payments? Any payments that are due, making them on time, making sure that you don't have any late payments. That's going to be the number one negative impact on your credit score. And those report 30 days late initially, 60 days. So every 30 days, if you are late on a payment, continue to impact that score more significantly. The other piece is the amount that you owe versus the available credit. So if you've got a credit card that has a $6,000 limit, you are only using $1,000. So you have a $1,000 balance on a $6,000 limit credit card. That's going to be a positive when it comes to your credit scores, because you're managing that credit properly. Now, if we've got a $6,000 line of credit and you owe $6,000, you are maxed out, that is going to have a significant impact on that credit score. So we're looking at it as you are extended on your credit, and that shows that there's a higher risk of default and missing those payments or going behind because you don't have the ability to borrow further. So that's definitely something that you want to consider as you're going into purchasing a home, is managing those credit cards and keeping the balances minimal. Also an important one, especially for younger home buyers considering, is the length of your credit history. If you have a very short credit history, you went through school, you didn't have student loans, you didn't open credit cards, you didn't get a car loan, and you don't have credit at this point, it also can be a negative impact on your scores, because we don't know. And so we don't know what that score is. We don't know what your history is of paying bills on time. And so they're gonna err on the side of caution and reducing that credit score just to really show that we don't really know. It's more a question. So it's important to get credit, use credit properly, and manage that credit over a longer period of time. And the longer you're able to do that, will be beneficial to those scores. And the other piece is let me flip back one, sorry about that. The other piece to consider is going to be that the type of credit. So there are several different types. When we look at a credit report, it can be a mortgage. There can be installment loans. Installment loans include car loans, personal loans. If you just took out like a consolidation loan to pay off some credit cards, those are going to be installment loans, which are a set repayment time. So it could be 24 months, 40 months, 60 months, and there's a set payment. So those are installment loans. And then a student loan is typically an installment loan. The next would be revolving. So your revolving credit is going to be your credit cards. So this is debt that is used and paid monthly, and it can change in any given month. And then the last one that can also have a dramatic impact on your credit score is new credit. So if you're considering purchasing a home, think about any new credit or anything that you're going to need to do over the next few months that could impact your ability to repay. So if you take out a brand new car loan, open a brand new credit card, that also goes back to that the length of credit history. Your credit score is going to reflect if we don't know what your repayment history is on a specific line item. So initially, that new credit is going to have a negative impact on your credit score. So as you're going into the home buying process, it's going to be important to consider maybe holding off on some of those purchases until you've closed on your home, and then potentially making some of those purchases after you close, so that it doesn't impact your ability to buy that home in the first place. There's also resources to check your credit score. Now it's gotten much easier than it used to be. Most of the financial institutions, whether it be your credit card companies, your bank, your checking account, all have ways that you're able to view your credit score online. So keep an eye on that. It's important to review that regularly. You can also get a free credit report through the credit bureaus, which there are 3 of them that we look at anytime we look at applying for a mortgage, and that's going to be Equifax, Experian, and TransUnion.
Okay, let's talk a little bit about home buying costs. So when you're planning to buy a house, there's a lot of different costs affiliated with that process, and they all come into play at different times. So first one you want to consider is your down payment. And as Matt said, we have lots of great programs. Your down payment can be as little as 0, and then it can go all the way up to 50%, depending on what you have and what you want to put down on the home. Miscellaneous costs. So from start to finish along the way, there's a lot of different costs that a buyer is going to run into. So the first thing you're probably going to be running into is the cost to have your credit pulled by your lender. Then the next thing is, once you get a home under contract, you could be looking at inspection costs. I would say right now an average inspection is probably running you around $600 to $700. When you're doing inspections, there's a lot to consider. So make sure you talk to your agent about what you need to be inspecting on the home. Anything from adding on a termite inspection or adding on an inspection to inspect the chimney. So make sure you really kind of know what inspections you're doing and what those costs are. Inspections can go as high as $1,500 depending on what you choose to have inspected on the home. Not all home inspections are created equal, so you want to make sure you kind of look through what your options are. The next would be repairs. There is a chance that your lender is going to require a repair to be made done on the home before you purchase it. So you want to make sure, again, connect with your realtor and with your lender. If there are repairs that need to be paid or need to be done, excuse me, who's going to do those? Is the seller going to do those? Is the buyer going to help out with those? So that's something that can come up as well. And then lastly, when you're looking at closing costs is a large umbrella. And what that really does is it kind of entails everything that kind of goes throughout this process. So when you close on the home, you're going to be looking at title insurance fees. We'll cover that a little bit more in detail later. Closing costs, recording fees for the deed and everything else, homeowners insurance. So all of those things get wrapped up into what we call closing costs. And Matt will go into that in a little more detail here next.
Thank you, Sarah. And so one of the most significant pieces of the cost of buying your first home or subsequent homes, of course, is going to be that down payment consideration. And in our example, the down payment can be anywhere from 0 to 20% or more. If so that down payment can be as much as you would like. And typically, the higher the down payment, potentially the better the terms in terms of lower interest rate and costs that you may receive, because with a higher down payment, the risk to the financial institution goes down, and which often allows you to receive a better interest rate or lower costs associated with it. So we've got two different scenarios here. In scenario A, Marta does not have any cash saved for a down payment. So we are going to put 0 down to purchase her first new home at the full $250,000 loan amount or purchase price. In this case, and this is fairly consistent with current market rates right now, the interest rate is going to be right around 7.125, 7 1/8 on that 0 down mortgage. So considering that with 0 out of pocket, 0 down, at the end of the first year, she'll have paid a little over $17,700 in interest alone. If we look at scenario B, Marta saved $7,500 for a down payment. So with this down payment, she's able to take advantage of a little better product, and she has to only borrow $242,500 from the bank. With that lower risk, she also receives a little better interest rate, and that interest rate at 6.375, 6 3/8, you'll notice ultimately results in about $2,500, just under $2,500 less each year in interest that she is going to have to pay. So you can see how additional down payment does help. It will keep your overall monthly expenses down, the cost down, and offer you better terms on financing.
Okay, so let's go over in detail all the costs that can be associated with purchasing a house. First thing, credit check. The lender is going to be pulling your credit probably not once, but twice. So you're going to want to check with them. So sorry about that. So you're gonna want to check with them and see what the cost is to have your credit check, how many times they're going to do that throughout the process. And then again, we talked a little bit about inspection costs, what that's going to run you. That is not going to be paid at the end of the process when you purchase your home. That is going to be something that you're going to have to pay out of pocket at the beginning of the process when you put a home under contract. Appraisal costs. Once you're done with your inspections and you have worked out any kinks with that, you're going to move on to the appraisal, which means the lender is going to hire an appraiser to come through, take a look at the house, and they are going to validate that purchase price for the lender. Sometimes that cost is paid up front. Sometimes that can be put into your closing costs. So again, check with your lender on how that's paid. Title insurance and title fees. So something that you're going to want to make sure you understand is what title fees and what title insurance actually is. So if you want to compare a title on a house to a title on a car, they are similar. However, you get a title to your car, which has the, the VIN number and all the details. On the house, what you get is a deed. It's not a title, it's a deed. But what you need is title insurance. When you purchase a home, you want that for a number of reasons. And basically, title insurance is a 40-year search of the history of that property. Some properties, of course, aren't that old and some of them are, but they're looking for flaws in the title. So chain of title, they're looking for issues with flood insurance, looking for issues if there was ever a fire on the property. So that search of a 40-year history is extremely important. And I actually think that's probably the most important piece when purchasing a house is title insurance. So for example, let's say you purchase a house, you have title insurance, and let's say in 5 years from now, somebody came to your door and said, hey, I own a piece of this property. I never signed off on a sale 10 years ago. Where do we go from here? That's when you go back to your title insurance policy. They should have gone through chain of title. They should have verified that everybody that had a financial purpose in the house actually did properly sign off on the sale. So title insurance is, again, very important to do as soon as you put a home under contract, and make sure you always keep that information, because 5 years down the road, you could have somebody come up and say, I own a piece of this property, and that's what you want to make sure that you have. Real estate taxes. Again, everybody has to pay real estate taxes here in Michigan. So that's something that you're going to want to budget for. Your taxes are going to take a significant increase when you first purchase a piece of property, and then every year thereafter, they usually increase 2 to 4%. So you want to put that in your budget as well. Repair costs, again, if you go through the inspection process and there are repairs that need to be made, it's not uncommon for a buyer to help out with repairs. It's not uncommon for a seller to make repairs. That is all up for negotiation throughout the process. Ongoing costs. So, there's a lot of other miscellaneous things that can come up while purchasing a home, kind of something that you don't think about. Let's say the house is vacant and you're going to purchase it, but you don't close for 2 months. Well, who's going to mow the yard? You don't want to be buying the house and all of a sudden you're walking into a field and then you have an issue with the township of them sending you a fine because no one's mowing the yard. So you want to make sure that, everything is being taken care of throughout this process. So there are some other costs that could come up. And then lastly, realtor fees. So we've had a change in our industry in the last couple of years in regards to realtor fees. Historically, when you buy a house, most of the time, a seller was paying the commission on the buyer's end. And that was how a lot of different states went through the process of dealing with realtor fees. Now, I would like to preface that all realtor fees are negotiable. Talk to your agent. Those are things that, you as a buyer have the ability to negotiate. But now, it is not set in stone in any way, shape, or form who is paying any realtor fee. It doesn't matter if it's the listing fee or the buyer fee. That is all up for negotiation. So as a buyer, you're going to want to sit down with an agent, be clear on what their fees are, say, hey, who is responsible to pay these fees? Most times here in Michigan, we still do see the seller chipping in for those fees, if not paying most of them. But that is now part of the negotiation process. So when you put an offer in on a home, you are going to potentially request that the seller pay your agent fees, and that is going to be a negotiation from here on out. So you need to be prepared, know what fees you're going to have to pay, and throughout that process, really be in tune to what the negotiations are. And it's going to be very important that you have a very qualified realtor to help you work through that process, since we did just have a pretty big change in our industry.
I have a question coming in from one of our attendees asking about interest rates.
All right, and I think we are moving on to
Can you guys hear me all right?
cost.
So home buying costs, closing costs. So again, we did talk a little bit about closing costs, but here's the list of what goes into that. Please note that closing costs go above and beyond what you're putting as a down payment. So let's say you buy a house at $300,000, your down payment is 5%, which is 15 grand. These closing costs are in addition to that. Usually closing costs are anywhere between 2 and 4% of the purchase price. That can definitely vary depending on lender, the area that you're in, and what you're doing. But some closing costs will, are kind of a list of the following: your appraisal fees, your tax service provider fees, your title insurance. I do want to make a note with title insurance. Title insurance is regulated by the state of Michigan. So when you're getting a title insurance fee, you can, as a buyer, you can use any title insurance company you want. That is up to you and that is your decision. But please know that they are regulated by the state of Michigan. So all the fees are going to be relatively the same, similar to how gas is regulated. So while you may want to get a couple of different policies, they're probably going to be pennies apart. Government taxes, if that's applicable, prepaid expenses such as property taxes, homeowners insurance, if applicable. When you purchase a home, you're going to have to probably pay for 1 year of homeowners insurance, either at closing or before closing. So that's something that you're going to want to do too. And either your real estate agent and or your lender should be able to help you with connecting you with an insurance broker. You definitely want to get multiple bids on insurance. Insurance on homes has really changed throughout the last couple years on what the process is. Insurance companies, some are now asking for your home inspection. And so after you get that home inspection, if you go to look up for homeowners insurance, they're going to say, I want a copy of that inspection. Sometimes that can be a positive and sometimes that can be a negative. So again, navigating all of these things, you just want to make sure that you have good representation on your side to walk you through all of these things that can pop up through the homeowners process.
Thanks, Sarah. Sorry, I jumped in a little early on you. The one additional piece of the overall closing cost and consideration for monthly payments when purchasing a home is going to be private mortgage insurance, and many times you may hear it referenced as PMI or MI. And what this insurance is many years ago, you could not buy a home with less than 20% down. And so what we saw as a barrier to many people buying a home, private mortgage insurance was born, and it allowed buyers to purchase homes with less than 20% down by adding this mortgage insurance to part of the purchase. And ultimately what it does is it insures the lender. So the financer, whether it's a bank, credit union, finance company, it gives them the ability to lend more than 80% of the value. It ensures that if the loan goes into default, if you miss payments, that the mortgage insurance company will reimburse or make the finance company whole again. So it really is an insurance that allows the lenders to be comfortable offering financing with much less down, anywhere from 3% to 5%, or even as low as 0 down. So it just has opened up the purchase market to allow for much lower down payments.
Okay, let's move into types of loans. So there are lots of different types of loans. Sometimes I like to call them products. Every financial institution or credit union will have different products available for you, different types of loans, different services. So it's really important to talk to 1 or 2 or even 3 lenders and figure out what product is best for your situation. So you have a financial institution, which is a Chase or Bank of America, a credit union, Consumers Credit or Lake Michigan Credit Union. And then you have your mortgage companies, which could be a Preferred Rate or could be a Ruoff Mortgage. They all have different pros and cons. So make sure you kind of check in with those. But it's very important that, again, you talk to your agent about potentially using a local lender. Using a local lender is very important throughout the process. And as somebody who lists lots of homes for sale, when I'm looking at an offer, I would much rather see a Consumers Credit Union pre-approval than a Rocket Mortgage pre-approval, which is out of Detroit and or California. And I say that because, let's say they hire an appraiser. The appraiser comes over from Detroit, may not know the Grand Rapids market. We may run into some issues here or there. So picking a local lender is extremely important in my eyes when I'm listing homes for sale. I know I can connect with somebody, I know where they're located, and it's very important. I'll let you jump in on those if you want.
Yeah, absolutely. Thanks, Sarah. And I think in terms of the different loan types, each one offers different benefits. The first one you'll see is an FHA loan. FHA was originally the low down option, so it allows as little as 3.5% down. There is mortgage insurance that you pay monthly as well, but that was a very nice option for many of the folks who were just getting into the market. I do see we've got a couple of questions. I'll finish up on these couple of different loan products, and we'll get those questions answered as well. Next one is we see the USDA. Often you'll hear rural development or an RD loan. These are loans that it almost sounds like you've got to live way out in the country for this. It's not necessarily the case. So just a little bit less densely populated areas. Many areas just outside of Greater Grand Rapids qualify for this product. Really nice benefit. It is a zero down program. So that's another option of that USDA or rural development loan. And then another really great product available is the VA loan for our veterans. This loan also offers a zero down option and very, very attractive interest rates as well. So many different options. And then the one that a lot of times we hear about most often is going to be that the agency loan or conventional loan, which is, you may have heard Fannie Mae, Freddie Mac. They insure those loans to allow banks to continue lending. And that's going to be your normal, what you would think of your 5% down, 10% down loans that you most typically do encounter today. So there's a lot of different things to consider. Most importantly is finding a lender that understands all of these, that's able to offer all of these so that they're all options to be able to make sure you choose the best one or have the best one available to you. One of our questions, and this is a great one, probably the most common question we get, is what is the best interest rate? What is that lowest interest rate that we can get today in the market? This is probably the trickiest question to answer because there are so many variables that have to be considered. And I think some of that is, again, we mentioned credit, down payment, but also the market itself. So interest rates move a lot, and they can move within minutes, they can move hours or daily. And I think it's going to be really important that you're working with a lender who's keeping an eye on those, the market and rates. Right now, as of today, a lot of times on a conventional loan, you're looking in the very low sixes. So anywhere 6 1/8, 6 1/4 is a reasonable rate to consider on a new purchase. Let me see, what were some of the other questions? Yeah, another great question is options for buying a home with a partner. If you're maybe, this can be a friend, this can be fiance, boyfriend, girlfriend, any of those things. And this is something that we see regularly. And I think the most important consideration is just the risk if something were to happen that would ultimately create a situation where people go in different directions. Legally married people who enter into a mortgage, there are laws and rules around what happens if they move in a different direction. When you're not married, it's up to the two individuals who are on that loan to figure out what to do with that property. So they have to be able to work together If they sell it, if one person refinances it or takes equity out to pay off the other one. So there's just some different things that have to be considered there in those situations. But we certainly see it in terms of being able to qualify, getting a home, in the price range that fits people's budgets. So not necessarily something that we discourage, and it is possible. Great question. Yeah, I think one other thing I would like to just note, it was mentioned in terms of lenders and working with different lenders. The consideration for any lender, and this can be large national lenders, this can be local lenders. The most important thing is in consideration is working with a loan officer that you trust. And ultimately that can be conversations that you have with them, availability, and just something that you want to consider. They can certainly be local. It is perfectly acceptable to work with large national lenders. We've mentioned Rocket. Rocket is a fantastic mortgage company. You see them marketed. Fifth Third, there are a lot of other great lenders out there. LMCU, of course, in our Grand Rapids market, does a tremendous job. So I think it is okay, and a lot of it is just simply perception in the market. And it can be the realtors also educating different sellers if they have an offer where a lender from outside the area is involved. So I just wanted to touch on that. The last piece, in summary, I think we did show a slide just briefly there. There are many other free resources available. And I think it's important to do your own research. There's a lot of information available. And it's helpful to understand the questions to ask. And a lot of times by doing the research, using some of these resources, it's going to allow you to better understand what you need to know, what you want to know as you're looking for and considering home ownership. So you can keep this information handy, and most of it is all free and easily accessible as you work through some of those considerations. And in summary, we have unloaded a lot of information, a lot of things to consider. And I think the most important thing to understand is your own personal financial situation and readiness to make a large purchase. And this even goes for any large purchase, vehicle, most importantly, of course, now considering buying a home. And so look at your figures, do a real deep dive into your personal expenses. Look and calculate how much you're spending. Figure out, now most of the banks allow you to, and credit unions allow you to itemize your expenses over an annual period, and you can see what some of those look like and use averages as you're figuring out your budget and what you can afford. And really sliding down to number 3, take your time, find a trusted agent, find a trusted realtor, a trusted loan officer to work with, and thoroughly review the cost, thoroughly review all of these things that we've talked about with them to make sure that it's going to be the best move for you. And then lastly, again, this is just going to be a complimentary digital resource that's going to be available to you. This is from Consumers. It allows you to, sorry about that, do a little bit of research and some very simple tools at Consumers Credit Union on our webpage just to help in terms of budgeting, investing, and also owning your home and some other financial pieces to help guide you along. And that is all that we have. Do we have any other? Feel free to open up any other questions we may have.
Yeah, I feel like you both did a great job in going through all of the questions that we had submitted before. I'd be curious, one area that you didn't touch on that's kind of a specific one is the idea of purchasing duplexes or multifamily homes. If you have any insights on that for those who are considering that option.
Yeah, I would be happy to jump in there. And there are a couple. For one, a lot of times there are different terms available for multi-units. So there may be additional down payment requirements. The historical risk for multi-units is a little higher, which ultimately means you're going to end up having slightly different terms. So your interest rate might be higher, the cost might be higher to enter that market or purchase that home specifically to begin with. But we do see a lot of that as people come out and want to buy their first home, and they understand they can offset some of the expenses by having either somebody living in a room with them or in another unit to help offset those costs. So it is something that we certainly do see, and we're seeing more of lately. Sarah, any other thoughts on that?
The only other thought I would have is make sure you get an agent who's very familiar with buying, duplexes or multi-unit housing. That is a different area of expertise. So make sure that if you want to do that, it's a great way to grow wealth. Just make sure you get somebody who's knowledgeable in that area.
Awesome. Thanks so much. And I see we have one question in the chat that maybe we can use to round it out. So this person has their boyfriend bought the house, but they're interested in building equity themselves. How can I do that? Are there options available?
Great question. And the very short answer is no, you are not able to build equity in a home that you do not have ownership in. Now, there are ways that you are able to gain an ownership interest. And I think by taking those steps, and I'll actually refer this over to Sarah on what steps can be taken in terms of taking ownership in a property that would then allow any equity that builds for you to have some of that ownership.
I think there's a couple of different ways you can look at it. If the significant other is willing to put you on a deed at a certain point in time, you can put on paper, what percentage of equity you would get in the home at a certain point in time. You can do that. That does get complicated. I think it's very important. You would have an attorney get involved at that point in time if that's what you're looking to do. There's, other things, maybe if you're living there, maybe you buy a small rental for yourself, and that's one of your projects in order to build your own equity. But there's lots of different options in order for you to get started. But that can be kind of a, tricky situation when you're dealing, with a significant other.
Thanks, Sarah. Yeah, that is that is one of those pieces that until you have an ownership interest, there, legally, there's no way to build that equity.
Awesome. Well, thank you both so much for your insights, your expertise, answering all of these questions. And I'm sure for those of you who are with us who have more questions, I'm sure Matt and Sarah would love to connect and continue to help everyone feel like they're on the right pace for what they want to accomplish. So thank you for everyone who joined us today. I hope you keep an eye out for other upcoming webinars, including our monthly Retire Well events, the continuation of our Financial Sense series with our alumni relations team. And I hope you all have a great rest of your week.